Okay, Assalamualaikum. My name is Arif Haikal bin Muhammad Jafri. My group members from Group 3 will present about Carillion Company. Okay, I will start the first one for the introduction to accounting fraud. In general, accounting fraud is the deliberate manipulation, falsification, or omission of financial data with the intent to deceive others for individual or corporate gain in order to present a false or misleading picture of a company's financial health, performance, or position. It entails purposely representing financial static. Okay, for the next one is turn at the top. In the case of Carillion, a UK-based construction and facilities management company that collapsed in 2018, there were serious concerns about the company tone at the top. Uh, Specifically, the company was criticized for its aggressive accounting practice and its focus on short-term financial gain at the expense of long-term sustainability. And for the next one is asymmetric information. When one side to a transaction has more information than the other, this is referred to as asymmetric information. For example, there were allegations that Carillion Company's senior management was not transparent about the company's financial situation, including its significant debt and pension obligations. This lack of transparency meant that investors and other stakeholders may not have had all the information they need to make informed decisions about the company's financial health. Uh, Another example of asymmetric information in the case of Carillion was the company use of accounting methods that were not widely understood or accepted in, in the industry. This made it difficult for stakeholders to accurately assess the company's financial performance and potential risk. Okay, for the next one is the role and responsibility of board of directors. Uh, Carillion Company Board comprises 7 directors, and the first one is an independent chairman, 2 executive, the CEO and CFO, and 4 experienced independent non-executive. In the case of Carillion, the board of directors had a number of key responsibilities, including the first one is setting strategic direction. The board was responsible for setting the overall strategic direction of the company, including identify key business objective and ensuring that these were aligned with the interests of the company's stakeholders. And the next one is monitoring performance. The board was responsible for monitoring the company's financial and operational performance and ensuring that act- active its activities were consistent with its strategic objective. And for the last one is managing risk. The board was responsible for identifying and managing this risk faced by the company, including financial, operator, and operational tasks. However, in the case of Carillion Company, it has been argued that the board failed to adequately fulfill these responsibilities. Specifically, the board has been criticized for first one is failing to identify and manage financial risk. Despite the company's mounting financial difficulties, the board continued to pay out large dividends to shareholders and executives and did not take action to address the company's high level of debt. In the report and accounting and account in account, in addition to the FD, 2 of the former non-executive of Carillion are qualified accountants. The Financial Reporting Council (FRC) is looking into how they prepare the financial statement. The going concern basis of accounting the carrying value of goodwill, 1.5 billion. The alternative performance measure employed and revenue recognition on important contracts are among the topics that are expected to be covered. And the next one is failing to challenge management. The board has been criticized for failing to challenge the management of the company and hold them accountable for their action. And lastly, failing to provide effective oversight. The board has been criticized for failing to provide effective oversight of the company's activities, including the financial reporting practice. And for the next one is human biasness and personal interest. In the case of Carillion, there were a number of examples of human biasness and personal interest that may have contributed to the company's collapse. For example, the first one is short-term thinking. The company's executive may have been driven for a desire to generate short-term profit and boost the company's share price rather than focusing on long-term sustainability. Okay, for the next one is dividend payout. The company continued to pay out large dividend to its shareholders, including its executive, even as it was experiencing financial difficulties. This may have been motivated by a desire to keep shareholders happy and maintain the company's share price. And for the last one, a conflict of interest. Some of the company's directors had personal interest in companies that were doing business with Carillion Company. This could have created conflict of interest that may have influenced the decision making of these directors. Okay, for the lastly, a fiduciary duty of board of directors. In the case of Carillion, the board of directors was responsible for overseeing the company's operation, managing its finances, and ensuring that the company complied with legal and regulatory requirements. Specifically, the board had a duty to: the first one is exercise due care and diligence. The directors had a duty to exercise reasonable care, skill, and diligence in carrying out their responsibilities. This include keeping themselves informed about the company's operation and financial performance, and ensuring that they had sufficient information to make inf- informed decisions. Next is act in good faith and in the best interest of the company. Director had a duty to act in good faith and in the best interest of the company as a whole, rather than in their own self-interest or the interests of particular stakeholders. Next is monitor the company management. The board had a duty to monitor the company management and ensure that it was acting in accordance with the company's strategy and objective. This includes ensuring that the company risk management system were effective and that management was taking appropriate appropriate steps to manage risk. And the last one is ensure compliance with legal and regulatory requirements. Directors had a duty to ensure that the company complied with all relevant legal and regulatory requirements, including financial reporting requirements. That's all from me. I will pass to the next presenter.
My name is Hazika binti Mat Basri. Now presenting about how the fraud was prepared and concluded. In July 2017, Carillion chief executive quit as it won on full year profit and pulled out of three construction market in the Middle East, taking a provision of 8,800 for 45 million pounds. Second, Carillion share decreased 30% as a result of analysis doubt that a series of cash saving initiatives would be sufficient to prevent a right issue. And the last, on July 2017, is a consortium that include Carillion won a 1.4 billion pounds contract to help build bring a high speed to railway. And second, on August 2017, Carillion said it had been named as a main contractor on a £300 million Manchester property development. Next. On September 2017, Carillion announced the departure of its finance chief along with a series of changes to its management. On October 2017, Carillion confirmed that it had received proposals from more than one counterparty for the proposal equation of its UK healthcare business. And the last is Carillion share increased by March to 25% after it agreed to fresh credit facility and proposed on some debt obligation. And the last is on November 2017 is Carillion want to contact with network right? Generating 2,000 million pounds in revenue. Next. Okay. This is who is well whistle blower. Emma Master as Chief Financial Officer, CFO. She worked at SVP and CFO Carillion Canada in January 2014 until March 2017. Then she is external auditor in KPMG, and the new is on 1 May 2023, Emma will officially succeed Olive as CEO. Thank you.
Okay, now I will proceed with my part, which is the pressures, opportunities, and rationalization. For the pressures, Carillion was led in growth and rising in debt. Carillion was the second largest construction company in the UK. It was also a significant strategic supplier to the public sector there. Around 4 to 0 public sector contracts were being worked on by Carillion at the time of its bankruptcy. Carillion misappropriated the government launched supply chain finance scheme in 2012, leading to its debt skyrocketing from £277 million in 2010 to £1.3 billion in 2018. It also bought rival companies without preparing for synergies and pursued growth recklessly. Early in 2015, UBS asserted the total debt was more than what Carillion was publicly disclosing, which is initially led to a sharp rise in short selling of Carillion share. Standard Life Investments sold it 10.8%. Equity stake in Carillion due to concern on strategies, financial management, and corporate governance. Second, Carillion faced difficulties in financial. Next. This is an income statement of Carillion. Revenue increase, net income will decrease. Despite revenue increasing 11.24% from 3.95 billion to 4.39 billion, Carillion PLC's net income decreased to negative 6.48% from 132.80 to 124.20 million over the past year. Despite rising revenues, the cost of goods sold as a percentage of sales increased from 91.37% to 92.02%, which contributed to the declining net income. Next. Cash flow of Carillion. Carillion do not make a large amount of money in 2016. Carillion PLC did not make a large amount of money in 2016 because the company operation generated 73.3 million in revenue for a cash flow margin of 1.67%, even though they provided 84.4 million more in financing that they did. The corporation nevertheless made 20,000 in cash from investment. Next. This is the last diagram, which is the balance sheet of a Carillion. Capital ratio. The debt to the total capital ratio for Carillion PLC is 172.88%, up from 7.03% in the prior year. Next. I will proceed with the opportunities. Aggressive accounting. Dividends are a good example of this. There is significant pressure on firms to, at the very least, sustain dividend payment because dividend constitute a distribution of profits. Next. Dividend and earning. Carillion spent £63 million more on dividends in the 5 years from 2012 to 2016. The EAB on cash from are often paid into installment, with the second installment being made in arrears the following year. Carillion distributed £554 million in dividend in the 8 years between 2009 and 2016, accounting for 3/4 of its revenue. It also paid out £333 million more in dividend than it did in cash from operations. Richard Adam, Carillion's chief financial officer, was held accountable by MPs for his aggressive accounting practices. An aggressive approach, the risk transfer, has led to fundamental faults in the way the government awards, requiring contractors to assume unacceptably high amounts of financial risk. Next. For the last part of this topic is rationalization. Dash for cash. Taking money from pensions, suppliers and investors while paying out substantial dividends to shareholders. Carillion used two methods to determine implied profit margins and project expenses: monthly management contract, assessment session, and peer reviews. Deloitte found that management overrode the peer reviews to ignore costs in order to express higher profitability. Accounting trick. In order to conceal debt and make the company's working capital appear stronger than it actually was, reverse factoring was used in this situation. Reverse factoring, also known as supply chain finance, was used by Carillion to amass hundreds of millions of pounds in unrecorded debt to its supply chain. Santander's early payment facility was reverse factoring, allowing suppliers to get payment before Carillion's 120-day waiting period. Next, I will pass to the next presenter.
Okay, now I, Noraina Safina binti Hasbullah, will present the consequence or effects or penalty imposed for the parties involved. So for the first one is the auditors. As the external auditor, KPMG has been sued by the government for 1.3 billion pounds sterling. So because of this, a lot of attention has been focused on the role of auditor, particularly and the opinion, even during on Carillion's balance sheet. So KPMG has earned a total 29 million pound approximately for its audit work without ever qualifying its opinion as it should be by adding caveats that one of concern if a major problem with company disclosures is to be discovered. So the absence of audit reflects over Carillion threatens trust in the process. As for internal auditor, Deloitte and EY as its internal auditor did not raise any significant concern about the company's governance, risk management, or internal controls. Carillion has paid Deloitte a total of 12 million pounds sterling in fees since outsourcing its internal audit to them in 2009. Okay, so for administrator, PwC and EY declined to serve Carillion as administrator prior to Carillion's collapse, out of concern that the company might not be paid for their service. And before that, the FRC has responded quickly by announcing its investigation into the work of KPMG since its staff mislead FRC inspector by forging documents in relation to its works on the account of Carillion and Regenesis, which is a software company. So there is a settlement with KPMG and Stuart Smith, a former employer, over the 2014 Regenesis audit was made public by the FRC. Smith forfeit 150,000 pound in fines and face a 3-year career ban from accounting. And also KPMG has admitted misleading the FRC during routine checks on the quality of its audit. Also, the lead audit partner, Peter Mehan, was fired from the corporation in 2021 after it suspended him in 2019. So the law against KPMG claimed the damage includes the amount Carillion's paid in advisory fee, dividends to shareholder, and losses sustained while the company was still operating. Thus, British audit regulations are being updated by the government as a result of numerous failures and probes that followed on this case. Next. Okay, so the next one is company. So there's these circumstances of Carillion's collapse and its consequences are being investigated by the FRC, the National Audit Office, and also the official receiver. Carillion collapsed in January 2018, which had 7 billion pounds sterling of that, which more than its annual sales of 5.2 million pound has turned into one of the highest profile accounting scandal in recent years. Moreover, Carillion relied on its supplier to deliver goods, services, and support for all of its contracts, but the Carillion treated them poorly with policies that included routinely disputing bills, late payments, and protracted reporting periodically. Although manipulating the obligation to supplier, Carillion ran out of cash with only 29 million pounds sterling on hand. So at last, Carillion declared itself insolvent due to run out of cash with just that amount and owned more than 1.3 billion pound to carry out the liquidation of Carillion with a process that continues half year after the company collapsed. Given that Carillion is insolvent and in liquidation, the FCA also chose to issue a public censure over a financial penalty. Okay, the next one is the management. As mentioned earlier, the board Carillion had 7 members. The insolvency service conducted a fast-track investigation on their action. The government has stated that Carillion executive and director won't receive bonuses or severance pay. However, there are several former executives receive pay and benefits that will include the former chief executive Richard Olsen, former finance chief Zafar Khan, and also the interim chief executive Keith Cochrane. So the impact is that there are governance failure in the Carillion since the board inability to manage principal risk which threaten the business model, future performance, solvency, or liquidity of an entity is a significant failure. So Carillion at last had high debts and traded on low margin. Next. Next one is the shareholder. Shareholder is the support service group Carillion are likely to have lost all their money on the stock after the business was placed in compulsory liquidation. As shown in the graph, we can see that the share price plummeted following the first profit warning in January 2017 and dropped even further as more warnings were made. As Carillion announced that its profit would suffer an expected fall of 845 million pounds sterling, there would not be any dividend for shareholder. The announcement caused Carillion share to lose 70% of their value in just 2 days and more than 90% since profit warning July 2017. And then the company, although there are financial difficulties, they receive large and risky contract, although profit warning has been issued. So this one also the impact to the Carillion company. In circumstances like Carillion, shareholder hardly ever receive anything back due to the high debt incurred. Although there was money raised from liquidating a company's asset, but it has been used toward paying off all a liquidated company's outstanding debts. Next. The lastly is pension impact. The pension impact, Carillion pension plan, which have a deficit about 600 million pounds sterling overall, contain money from thousands of current and former employees. It has a 587 million pounds sterling pension gap that puts at risk the retirement fund of 28,500 people. The Pension Protection Fund, PPF, will be in charge of managing those funds. Because Carillion was run so carelessly, its pension plan might have ended up in the PPF. So Carillion collect with net pension liability of about 2.6 billion pounds sterling and no chance of anything being recovered from the rubble to offset them. Member of pension plan will have their benefits lowered, while charges on the pension plan will pay for their decreased payout. Next, I pass back to Mimi Maisara.
For the conclusion, KPMG, Deloitte, EY, and PwC were conflicted in the Carillion case due to lack of competition in the audit and professional service market. The government has the courage or decisiveness to pursue policies that could significantly alter regulatory frameworks, and other initiatives to improve the business climate need to be reviewed. The government's effort to save costs have been caused business to focus on volume rather than value and price rather than service. The right alignment of incentive is in the investment chain is a difficult balance, and the audit profession is in danger of suffering accuracies in confidence. I will pass back to Aina Sofina.
So the last part is that the lesson learned through completing this assignment is the constraint of today's financial statements and the limitation of audits. The financial statement must present a true and fair picture of a company's financial situation year by year. There are numerous stakeholders of a company, including customers, suppliers, employees, and investors who depend on the financial statement, may then promptly assess the risks associated with doing business. One wisdom that we want to share is that the size gives no guarantee to stability. The collapse of Carillion shows that there is no clear correlation between size and stability. No one is too big to fail, since Carillion may owe money to 30,000 smaller businesses. So the systemic danger presented by large contractor like it is now become a political program. So now the smaller competitors seem to be in favor since larger contract within their reach. So that would be all from us. Thank you.